Ladies and gentlemen, good day and welcome to Skipper Limited Q4 FY24 earnings conference call hosted by Ambit Capital. As a reminder, all participant lines will be in listen-only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touch-tone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Prakhar Porwal from Ambit Capital. Thank you and over to you, sir.
Thank you. Hello everyone. Welcome to Skipper Limited's 4Q FY24 earnings call. On the management side, today we have with us Mr. Sharan Bansal, Director of the company, Mr. Shiv Shankar Gupta, Chief Financial Officer, and Mr. Aditya Dujari, General Manager Finance and Investor Relations. Thank you and over to you, sir, for your opening remarks.
Thank you, Prakhar. Good evening, everyone, and thank you for your continued interest in Skipper. Before we delve into our operational financial highlights, I would like to emphasize that any forward-looking statements made during the call should be viewed in light of the risks facing our industry and company. Now let's review some key operational financial highlights compared to previous year's quarter. I am delighted to report that Skipper achieved its best ever revenue quarter, reaching rupees 1153 crores compared to rupees 657 crores in the previous year's quarter, representing a remarkable growth of 76%. This exceptional performance was driven by strong results across our engineering and infrastructure segments, while maintaining a healthy operating EBITDA margin of 9.4%. Segmental revenue breakup revealed significant achievements. Engineering revenue reached an all-time high of rupees 701 crores, up by 41% from the previous year quarter, while polymer revenue stood at 103 crores and infrastructure segment revenue soared to rupees 349 crores, marking a remarkable growth of 3034%. Our Q4 engineering export sales reached rupees 198.7 crores, constituting 28% of overall engineering segment revenue, with year-to-date export sales totaling rupees 635.6 crores, contributing significantly to our revenue growth. In the infrastructure segment, we achieved our best ever quarterly revenue, fueled by robust execution in BSNL and other T&D projects. We anticipate this momentum to continue into the next quarter. Now moving on to our quarterly financial performance, reported consolidated EBITDA increased to rupees 108.6 crores, with operating margin standing at 9.4% for the quarter. Engineering segment EBITDA margin reached 11.6%, reflecting our focus on executing better quality contracts and expanding our international business. Going forward, we expect to maintain consistent margin performance in the engineering segment, supported by our strategic initiatives, while the polymer and infrastructure segments will continue to benefit from rationalizing fixed costs over a larger revenue base. Our management remains focused on bottom line improvement, with consolidated PBT increasing to rupees 47.6 crores and PAT reaching rupees 25.2 crores for the current quarter. Our 12-month annual period performance highlights were as follows. Revenue for FY24 surged to rupees 3,282 crores, exceeding our guidance of 25%, while maintaining margins at 9.7%. Engineering business segment revenue grew by a remarkable 46%, while polymer business revenue increased by 11%. Polymer sales volume witnessed a substantial increase, reaching approximately 32,000 tons compared to approximately 25,000 tons in the previous year period, registering a growth of 30%. Consolidated PBT and PAT saw significant improvements, with PBT reaching rupees 128.5 crores, and PAT reaching rupees 81.7 crores, reflecting a growth of 157% and 129% respectively compared to previous year period. Our commitment to financial discipline is evident, with finance cost as a percentage of sales improving to 4.7% compared to 5.2% in the previous year period, and net working capital cycle improving to 88 days against 131 days in March 23. Order book and inflow. During the quarter, company secured significant size domestic contracts from PGCIL and international T&D projects, contributing to a total inflow of 1,141 crores. Year to date, the company secured orders exceeding rupees 4,286 crores, marking the highest in company history for a given year. Our current order book stands at an all-time high of rupees 6,215 crores, well diversified across sectors and segments. With an order book to engineering and infra segment sales ratio of 2.2 times FY24 sales, we have revenue visibility for the next 2 to 3 years. The vibrant domestic T&D environment aligns with Skipper's commitment to leverage India's transmission sector growth. While the government focus on scaling renewable grid infrastructure and improving electrification, Skipper is poised to support this growth. Our diversification into telecom, railway electrification, water EPC, and drip irrigation further strengthens our revenue stream. The tender pipeline remains deep, with the current bidding pipeline at an all-time high of rupees 16,730 crores, reflecting strong opportunities in both domestic and international markets. We are in advanced stages of negotiation to secure sizable international and domestic contracts. In conclusion, Skipper Limited continues to deliver strong operational and financial performance, driven by our focus on execution excellence, strategic initiatives, and prudent financial management. We remain optimistic about the future and are confident in our ability to create long-term value for our stakeholders. Thank you, and I am happy to take your questions now.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touch-tone telephone. If you wish to remove yourself from question queue, you may press star and 2. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Dhruv Agarwal, an individual investor. Please go ahead.
I'm audible now?
Yes, sir.
Yes, Mr. Dhruv, please go ahead.
Yeah. Good evening, sir. Congratulations on the best ever quarter, sir. So my first question is, sir, there has been a huge fall in the gross level margins over year on year and over quarter on quarter, sir. That is, it has been fallen to 21% in quarter 4 FY24 from 36% in quarter 3 FY24. So can you please explain me the reasons for the change, sir? That is there any one-off items in the cost of goods sold or something else, sir?
Actually, our margins our margins need to be seen on a 12-month basis, and we have delivered consistent EBITDA margins. Last year, for a 12-month period, our EBITDA was 9.7%, and it is the same 9.7% for this 12-month period also. See, quarter-on-quarter margins can be misleading depending on the quality of the contract being executed. So, honestly, on an annual basis, I believe we have delivered consistent EBITDA margins on a much higher revenue base.
Sir, if I compare on the annualized basis, I'm just basically talking about this gross profit margin, sir, not just EBITDA margin. If I compare the 12 months also, sir, it has been fallen from 36% to 24%, sir. So, what was the reason, sir?
I'm not very sure where you are getting this number of 36 and 24, sir.
Sir, if I deduct cost of goods sold from the sales, sir, then we will get the gross profit, sir. So that's what the calculation and basically...
That's not a correct measure to see the company's performance, sir, because the cost of goods sold may be varying because of various factors. It may be due to project sales, and also you have to look at the labor, stores and other project expenses. So that is not the correct measure to see the gross profit of the company.
So sir, what was the reason in this quarter, sir? Can you please highlight?
What was the, sorry, once again?
What was the reason for the increase in cost of goods sold, sir, in this quarter, sir, particularly?
Particularly cost of goods sold, look, like I said, you have to look at both the amounts together, which is cost of material consumed, the change in inventory of finished goods, and as well as the labor, stores and other project expenses. So if you look at all three of them combined, previous year average was about 72%. This year is about 76%. But then maybe maybe it is getting compensated on the other expense side, where the other expenses were 14.1% previously on the previous year, and it is about 10% in this year. So which is why the EBITDA margins are the correct margins to see, and more so the PBT margin for really seeing what the actual profitability of the company is.
Okay, fair enough. Sir, the net working capital days has been brought down to 88 days from 131 days. So can we expect going forward this kind of working capital days to remain on this level only, sir?
Between a net working capital of 90 to 100 days, we believe that this is should be consistently maintained, and obviously the effort will be to improve upon that.
Okay. So, sir, there has been increase in the long-term borrowing. Is it for the purpose of this capital expansion, the capacity expansion that you are doing? Is my understanding correct, sir? And further, we will not be requiring any further borrowing for the said capacity expansion?
No, there will company will take a combination of company will use a combination of internal accruals and further long-term borrowing to fund our capex plans. The previous long-term debt which has been taken has been towards debottlenecking and optimization capex. For this year capex, we have not yet planned about how much debt to raise.
Okay. So sir, by what time do you expect this capacity to live in, and after that, what kind of orders the company is able to capture, and what would be the peak revenue post this expansion, sir? Can you please highlight on that, sir?
In terms of revenue, as I said, as we mentioned in the investor presentation, that even on the enhanced, earlier in the beginning of the year, we had guided for a 25% CAGR growth. However, this year we have delivered close to about a 66% against our guidance of 25%. Now, even on this enhanced revenue base of approximately 3,300 crores, we are maintaining our revenue guidance or revenue growth guidance of 25% for the next 2 years at least. So, in terms of capacity, currently we are at about 3 lakh tons of capacity, and with this year the capex that we will do, we will end the year with a capacity of 3,75,000 tons.
So sir, it will be live by quarter 4 or quarter 3, sir?
Some part of it will come alive by quarter, maybe towards end of quarter 3 or quarter 4. And the full capacity will be available from next year onwards.
Okay, by FY26, we can expect to fully go on.
Yes, but also looking at the opportunity, we are looking at further capacity expansion next year also.
Okay. Seeing the demand outlook, right, sir? So, just on the question on that, sir, as I can see in the presentation that you have mentioned the order bidding pipeline. In the order bidding pipeline, there has been almost 65% bidding from exports. So, going forward, do you see a huge opportunity in the export only, or like you can see from the domestic as well? As you can see, the government has been spending lots on the infrastructure space. So what would be your focus area, sir? Whether it would be on domestic markets or it would be on the international front, sir?
Yeah, it's a good question. This year also looking at the strong focus of the government on infra spending, and the good number of projects under the TBCB mechanism being bidded in transmission field, we do expect very, very robust order inflows on the domestic side. However, the domestic pipeline looks shorter because the domestic tenders tend to be more short-term and they get decided faster. But international projects, they have a long lead time, from bidding to finalization, which is why the international pipeline always appears a little larger. Our focus continues to be on both areas, domestic and international. But yes, we do expect that majority of the orders this year also will be coming from domestic.
But sir, as you can see, the major of the bidding pipeline is from the...
I request you to return to the question queue for follow-up questions.
Just on this same question, Odhiman, just last in this question. So, sir, as you can see, there has been almost 65% of the bidding pipeline from export. So we can expect, like, going forward, there will be an order inflow from the export orders, and you will be executing the export orders more than the domestic orders. So is that correct, or like is there something else as well, sir?
No, like I said, the international order bidding pipeline always appears larger because the time for finalization is longer. Domestic tend to get finalized faster, which is why the pipeline appears smaller. However, we do expect that over the overall order inflow of this year, we expect close to about a 75-25 mix, where 75% will come from domestic and 25% of the orders will come from exports.
Okay. We join back the queue, sir. Thank you so much, sir.
Thank you.
Thank you. Next question is from the line of Deepak Purswani from Swan Investments. Please go ahead.
Yeah. Good evening, sir, and congratulations for pretty strong execution during this quarter and for the year. So firstly, in terms of the BSNL order, how much was the revenue booked during FY24 year as a whole, and how should we see trajectory going ahead in FY25?
For BSNL order, we have executed close to about 1,000 crores in this financial year that just ended. And in the coming year, we expect a revenue of close to about 700 crores from BSNL projects.
Okay. And secondly, sir, in terms of the engineering, in terms of the overall guidance, since we have mentioned we would be looking out for the CAGR of 25% over the next 2 years, could you please break up in terms of the segment-wise, especially in the engineering product, where I think from the capacity point of view, we are running at a high capacity level. What is the CAGR we are looking at out? And also, second is the polymer business. If you can throw some light on this business as well, because year as a whole, our growth has been 11%, and in Q4, actually it has come down by 30%. So if you can throw some light on both of these segments, that would be really helpful.
I don't have the guidance segment-wise readily available with me. We may share that at a later time with you. Aditya Dujari, if you can get in touch with, he would be able to share that with you. And in terms of capacity utilization, we are still at about roughly a 70% capacity utilization. So there is some opportunity to drive more revenue from the existing capacity in the current financial year itself. And towards the end of the year, we should be getting the benefit of our enhanced capacity, which we are now going to be taking up the capex for.
Okay. And sir, in terms of the margin as a whole from the FY25 perspective, how should we look on the consolidated level margin? Should we expect margin to expand from here at the current level, or it will remain at the current similar level to the FY24?
Go 10% plus in the current financial year. However, any margin between 9.5% to 10%, we are quite comfortable as a company, and we believe that more and more that PBT margin will be driven better because of the higher revenue base, leading to lower finance costs and depreciation costs.
Okay. So, sir, actually, coming to the interest expenses, how should we look from the FY25 perspective? Because this year, I think, especially in the second half, interest expenses seems to be little on the higher side. I mean, going ahead, how should we look into as a percentage of revenue for the FY25 year as a whole?
I believe right now we have done very well this year in bringing down the interest cost from earlier 5.2, I believe, 5.25 to 4.7 approximately. So certainly I think in the coming year, anywhere between 4.4 to 4.5% would be our target to take the finance cost as a percentage of revenue.
Okay. And also, sir, could you please also throw some light in terms of the fund-based limit and non-fund-based limits and how much is currently utilized?
In terms of fund and non-fund, non-fund itself is not 21. About 2,100 crores is fund, non-fund.
Non-fund.
Non-fund. About non-fund limit is about 2,155 and fund base is about 525.
And how much of
utilization is about 60 odd percent.
in both the fund and non-fund both? Or?
Non-fund is more. Non-fund is close to about 80 to 90% and fund base is generally 60%.
Okay. So, sir, from the bidding strategy point of view, going ahead, I mean, how should we look in? Because our non-fund base is currently at 80 to 90%.
How should you, I didn't understand the question.
I mean, in terms of the announcement of the non-fund limit in future?
Well, that will be based on the company's requirement and the kind of projects we expect to get. So I believe that will be really based on the company's working and requirement from time to time.
Okay. No. Thank you. Thanks a lot, sir.
Thank you. Ladies and gentlemen, in order to ensure that management is able to address questions from all participants in conference, please limit your questions to strictly only 2 questions per participant. Should have a follow-up question, we request you to rejoin the question queue. Next question is from the line of Balasubramaniam from Arihant Capital. Please go ahead.
Good evening, sir. Thank you so much for taking my questions. Sir, one of tower infra provider have surpassed more than around 2 lakh towers, and we have seen strongest tower additions based on increase in 5G rollouts and rural expansions. And what's your thought process on the telecom side for tower additions and what kind of demand you are experiencing?
Yes, on the telecom side, certainly telecom makes up close to about 30% of our overall order book, and we are seeing quite a lot of vibrancy in this sector. We believe that operators which were not so active earlier, for example BSNL and Vodafone, both will be quite active in the coming years. Because their network expansion has probably been they haven't invested so much in their network over the last 4 or 5 years compared to other operators like Jio and Airtel. So certainly there is a good opportunity. Vodafone FPO success is also a big positive for the sector. So I believe that with the upcoming expansion of both BSNL and Vodafone, as well as the ongoing expansion of Jio, we should look at a good demand growth in the telecom tower space.
Okay. So out of 6,215 crore order book, what would be that breakup in terms of engineering and other breakups, like polymer infra and engineering breakup?
No, so we don't have any order book on the polymer side because that is sold to our retail network. And in terms of the overall order book breakup, we have just a minute. 13%. Exports is 13% and total domestic is 87%, out of which T&D is 53% and non-T&D is about 34%.
Got it, sir. Thank you.
Thank you. Next question is from the line of Darshil Zaveri from Crown Capital. Please go ahead.
Hello. Good evening, sir. Hope I'm audible.
Yes, you are.
Yeah. Hi. So a lot of my questions have been answered. So just wanted to ask, sir, with our order book of like around 6,200 crores, what would be our execution timeline for that, sir?
Normally, the execution timeline is between 2 to 2.5 years.
Okay, sir. And so we have a great pipeline for us. So what kind of like win rate are we seeing for that, sir?
See, it differs from market to market. As the bidding pipeline is growing, the win rate is also changing quite frequently. Very hard to put, a win rate. In certain markets, I can tell you our win rate is 50% plus. And in certain markets, it is as low as 10 to 15% also. So on a blended basis, I think roughly we can assume that we do enjoy a 25 to 30% win rate among the bidding pipeline, but that's a very broad generalization. It really differs from market to market.
Oh, okay, sir. So why I was asking this question is basically we've given our 25% growth rate target, but with our order inflow and pipeline, it can be is it a fair assessment that, we can again outperform our, stated guidance, because that's the way it's looking with all the macro factors also, sir?
Yes, it will certainly be our target to outperform our given guidance.
Oh, perfect, sir. And so just like with the rates of our margins, we think on the bottom line we expect a better rate. So could we just think of our EBITDA as a gross margin, and everything else that flows down PBT will be we'll be able to get maybe in FY26 a very higher profit margin totally because after our capex, or how would that work out?
I believe that company is looking at continuous improvement in all margins, whether it is EBITDA margins, PBT margins or PAT. We don't want to give any particular guidance beyond what I have said earlier right now. However, obviously with growing revenue and better quality contracts, more export markets, I believe there is a lot of scope for margin expansion in the coming years.
Oh, perfect, sir. Just one final question, sir. So any kind of risk, like in terms of, regulatory risk or something that, that can hamper us, our growth prospects, maybe telecom sector or something that you see as a, risk, that something that can hamper us?
No, we have absolutely negligible bad debts in our company. So we don't see any kind of receivable risk on that side. Oh, regulatory. I'm sorry, you were asking about regulatory.
Yeah, any kind of, maybe an industry norm changes or something on that sort of like, that can hamper us, maybe,
Not really, no. I think there are no our business, I don't see any sort of regulatory risk at all.
Oh, perfect. Thank you so much, sir. All the best, sir.
Thank you.
Thank you. Next question is from the line of Rishi Kothari from PI Square Investments. Please go ahead.
Hello. Yeah. Hi. Thank you so much for the opportunity and congratulations on the numbers. It has actually very stellar performance. On the question front, I would like to ask that I saw a point in PPT that the engineering products made from the broader market is developed market, that is North American, Asia Pacific and West African. So it was generally been order coming from the Chinese market and Turkish market. So what exactly made the shift to the players from the China market to the Indian market and specifically to us? Is it because of the product specification that we generally provide, or is it because the market, or is it because geopolitical reasons that we see around the world?
It's a good question. I think overall what we are seeing that like in most industries, buyers around the world are adopting a China plus one strategy, and more customers are trying to move their supply chain away from China. So certainly there is a very strong opportunity for good Indian manufacturing companies to take that space being vacated by Chinese companies, and I think that's something which we are also benefiting from around the world. So I feel that this trend will continue. Of course, the change will happen gradually.